Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Bring you another in this series of videos I've been doing on portfolio construction. Now, I want to make some qualifying remarks here. The first portfolio I built was for a theoretical or hypothetical situation where the investor had $2 million they needed to invest, and they needed to generate enough income from that $2 million to live off of because they were retired and no longer working. It's just a hypothetical situation. Now, in theory, that person should have been investing their money when they were young and building up a portfolio that they could either convert to a dividend, to a growth portfolio for higher yield, or simply have that portfolio already supplying the income they need. But nevertheless, I generated that portfolio and it created a 5% yield, which generated over $100,000 a year in income, which that person was used to living on and could comfortably live off of. Now, the next portfolio I was going to build theoretically, or I have built theoretically, which I'll be covering today, is a portfolio for pre-retirement income for people who had time before they retired that they could start building a portfolio. They had maybe decades, 10, 20, 30, 40 years, and then how they would construct a portfolio. But I'm also going to say, in theory, for someone in that situation, perhaps the best way for them would be to accumulate wealth by generating in growth stocks, especially when they were younger and they could afford to take the risk. So there is no one way is the best way to do this. These are just different ways, but what I'm hoping you're going to see here is that all of them are based on common sense strategies, okay? And so what I want to do, though, is let's go into the fast graphs because I want to revisit a couple of things and make another very strong point, and that is that value investing has always got to be a part of whatever portfolio you construct. And the reality of it is when you're dealing in a market like today, well, let's look at that market before I go on. When you're dealing with the S&P 500 here, this is the S&P 500 ETF Trust, I want you to note that the orange line on the graph would represent the intrinsic value, or what I like to call the intrinsic value treasure map, or the true value treasure map. That's the value of the businesses making up the S&P 500. The blue line is how the market prices it. We call it the normal PE ratio. And then the key line here would be the price line, which I call the market roller coaster. This is where prices go up and down, up and down, up and down. And then the gold line, which is the golden apples growing on a tree, these are the dividends that it's paying. And we're talking about dividend growth portfolios with these series of videos. Now, here's the point. Back in 2014, 12, 13, coming out of the Great Recession, the S&P was fairly valued, and it would have been a great investment. Now, investors often argue about whether you should just put your money in an index fund. I would argue that that would be a sound strategy back in during these days. I don't argue that it's a sound strategy when the market is as highly valued as it is today. Okay, because you're not going to participate in the gold or the orange line, which is the true value treasure map. You're not participating in that if you're overpaying for the stock. And today, I would argue that you're overpaying for the market by something like over 30%. All right. Now, you have to take what the market could give you. Now, there are common stocks that I really like. These would be what I would call the best dividend growth stocks. These are the ones that I would choose if I had that market back in 2011, 12, or 13. In fact, I did choose many of them during that time. Okay, but today, Apple, for example, is overvalued. It would have been fairly valued back in this market. Here's automatic data processing. It was fairly valued back in this market. I would have bought it then. I won't buy it today because it's overvalued. These are some of the really great dividend growth stocks that you could invest in. Here's American Express. Once again, it would have been at fair value back here. It's now overvalued. Now, I'm not going to go through all of these, but names like Home Depot. Home Depot was a great dividend growth stock, one of the really high quality companies. And these are the ones that I would prefer to invest in, given the opportunity to invest in them, meaning that the market gave them to me at fair value. It would have done that in 2010, 11, 11, and 12. But I'm not investing in them now. Another one that everybody would relate to perhaps would be McDonald's. McDonald's is a great company. They've produced really great results for a long period of time for investors. But once again, price is what you pay, value is what you get. I could have bought McDonald's back here. I'm not buying it up here. And then finally, last but not least, and I could show you many, many more, there's Cisco, the food company, Procter & Gamble, Microsoft, MasterCard, and let's look at Visa. These are the dividend growth stocks that I would really like to invest in if I was a young investor, okay, and I was looking for the future. But today the market doesn't give you that. You could have bought these stocks all at reasonable valuations back then. All right, now let's go back though and visit the portfolio I built for retirees. When I needed this high level of income, this portfolio's current yield is 5.28%. The reason I'm bringing it up in this video, even though this is about the future video, is because I've made an adjustment here. All right, as I was going through the portfolio, I was evaluating Avnet, and I discovered I really didn't like it based on its cash flows. So what I did was I replaced Avnet. Now let's go ahead and look at it real quick. I replaced Avnet with Enterprise Products, which was a higher yielding, more cash flowing investment opportunity. What I didn't like about Avnet, now I bought Avnet at a price of $45.18 and I sold it at $48.20. I sold it for $106,714 hypothetically, and I had bought it for $100,028. So I made about $6,000 on it in terms of profit, and then I went ahead and put that money in Enterprise Product Partners. Now this has a 2.84% yield. By switching to Enterprise Product, or just under 3, it was probably closer to 3 when I actually bought it. Now I bought a stock that's yielding 6.74%. And of course, I bought it at what I consider to be an attractive price of $31.99, and it's currently $32.33, so I've got a slight profit in it. But my point is, I've made that adjustment now, and I do want to emphasize, you need to manage your portfolios and make your decisions based on what is basically happening in the market and what's happening with your companies. If your companies deteriorate or start having issues, then you would want to go to another company. All right, now this is the portfolio we're going to be featuring today. And I want to emphasize that I invested a lot less money here. I invested $149,000. I'm going to invest $200,000, and I'm going to put $10,000 in 20 stocks, assuming a younger person doesn't have the money that a person that's facing retirement has. So this is a portfolio for the future, a portfolio that's capable of generating future income for the investor. And so let's look at an example of that. Let's look at a stock like FedEx here. I mean, the FedEx is a little bit cyclical, but the company has grown over time, and we bought it, and their dividend has steadily increased over time. So let's go ahead and look at the performance of FedEx, and let me make a very strong point here. Okay, I'm using the newest first right now, but I'm going to switch that to the oldest first. All right, so what we had was, if we'd have bought the stock in 2006, FedEx, they paid 32 cents in dividends, that my yield on cost would have been 0.36%. In other words, it wasn't much of a yield. But every year you can see that they've raised their, or not every year, but over the years they've raised their dividend significantly. So my yield on cost today would be over 6%. This is 20 years later. So the point being is that growth yield, that's where, as an investor, you deserve a raise in pay every year. Okay, so what I've done is I've created a portfolio. It has a 2% current yield. Now that's important because people always talk about beating the S&P 500. I'm looking for income portfolio here, building one. The S&P only delivers 1%. This portfolio is delivering 2.1%. So I'm getting virtually, we'll call it twice the income off of this portfolio than I would if I invested in the S&P 500. And a lot of these are S&P 500 companies. But what I'm focusing on here is growth. If I look at Raymond James Financial, for example, this is a company that's consistently grown. I bought it at a reasonable valuation. It only has a 1% dividend yield. It's A-rated. It has 25% debt. And once again, when I look at performance, this company has increased its dividend every year. So my first year in 2006, I would have received a 1% income. But because they've increased their dividend per share year after year after year. By last year, I'd have been getting over 13% income off of this stock. That's what I call it, growth yield. Everybody refers to it as yield on cost. Okay, so let's evaluate some of these companies. I want to put this in a perspective for you. Let's look at a company like Amgen, okay, which is the world's largest biotech company, which I've added to the portfolio. This has been a very growthy, very consistent growing stock. Now, I want to make something clear here. The orange line on this graph is the true value treasure map. The orange line on the map is the growth of the business, and that's why it's a treasure map, because the treasure is the business increasing its value every year as an operating company. Okay, the dividends, which is the gold line on the graph, these are the golden apples that grow on the tree. These are the things that are paying you income. This area below the golden apples is what's paid out to you as an investor. And then, of course, the roller coaster is the stock price, which is going up and down all the time. Okay, so I'm focused not on the price other than how it relates to value. I'm focused on the treasure increasing every year. So I'm looking at this as my treasure map. And then I'm looking at the golden apples. This treasure map is actually a tree, a growing tree, if you will. And these are the apples that it is throwing off of the tree. And I'm going to ride the roller coaster along the way. It's going to have all kind of ups and downs and lumps and so on. But if I look at these stocks like Ameriprise, you can see the periods where I'm going to have a lot of volatility, but over time, earnings drive market price. And when I buy a stock like Ameriprise this cheaply and look at it from the future growth potential of the company, and that's what I'm looking at here, I've got a potential 8% growth. I bought it at a PE ratio of 12.4. It's increased to 12.43, but I'm expecting it to increase to 15. So if I point out here, I can make 20% a year, but I can also get the growing income that I'm looking for. All right, so these strategies are how I've aligned this. Now, I want to make a point about overvaluation, okay, because overvaluation is critical. And I want to make some prospects of why I think buying at value is so critically important. If I look at a growth stock like Align Technology, and we see this period in 2019 and 20 where the market could appreciated this stock a lot more than I do. They drove the value up to 75 times earnings, an insane price-earnings ratio. Now, here's the point. If I'd have bought that stock there, or if you bought it anywhere in this tip of this little mountain chart here, in the tip of the mountain here, and held it to today, you obviously see that you'd have lost a significant amount of your money. From peak to trough here, it's about 78%. But even if I'd have bought it here and held it to here, I would have still lost 72%. But here's the point I want to make. If I look at a stock like this, expecting if I had bought it when it was overvalued and it was a popular stock, and it did it for years, it stayed overvalued for years. I want to make that clear. We've got 1, 2, 3, 4, 5, 6, 7, 8, 9 years, a decade of overvaluation, and all given away. Even if I'd have bought it here and held it to now, I would have actually lost money over a decade. They talked about the lost decade after the 2008 crash. The market gave away all its gains. Well, when you look at these overvalued stocks, you look at a stock like American Tower, great cell tower REIT, you buy it here and you hold it through here and you make less than 0.5% a year, including dividends, by the way. You end up losing actual principal because valuation matters, and it matters a lot. And these are just some examples that are already happening in what I call the stealth bear market. Alexandria, a REIT, of course, it hit some bad fundamentals, but you can see the valuation reverted to the mean, and it became classic. So Crown Castle, another one that had the valuation revert to the mean. These are Epam. Look at the growth of this stock. Look how the market. So no one's denying that the market can. And this did this for, again, 3 or 4 years before the comeuppance. But again, the point I'm trying to make, and I want to make this as clearly as I can, when you look at these stocks, when they get undervalued, you can see it over and over again. Let me do a stock that might show some, maybe, no, Nike won't give it to me either. Nike's another one. Got way overvalued, and then look at the results. So valuation does matter. All stocks, a lot of the stocks, the sums I showed earlier, haven't fallen in value yet. But if you bought Paycom today, odds of it getting back to fair value are pretty high. If you bought it here, odds of you getting back to that value are extremely low, and you might never see it in your lifetime. So valuation matters, and it matters a lot. I don't think you could own PayPal for decades, and I don't think you'll see it trading at a 70 multiple and be back to $300 a share. Had you bought it somewhere in here, you'd be losing money, and those are permanent losses. Where when you get stocks that are undervalued, for example, and let's go back and look at Ameriprise as an example that I showed you earlier. If you go back and look at a stock like this that gets undervalued during times, we'll call it times when the market's being irrational, you see it get undervalued like we did here in 2018, and you bought it at $103 a share. It wasn't very long. It was weeks and months that you would have gotten a profit in the stock, okay? But if you buy these high value stocks at those high valuations, that could take forever. So I'm going to stop here for this version of the video, and we're going to go look at this portfolio that I've built for the growth investor, and we'll come back to that and talk about how I constructed it and what the construction was and what the kind of companies I was looking for. But again, that would be a portfolio built for future retirement, not current retirement. Anyway, I hope you liked this video. If you did, give me a like, ring the bell, subscribe to the channel, the YouTube channel, and subscribe to FastGraph. This is part A of a two-part series on building a portfolio for younger investors that have years to wait for retirement. But I want to repeat, this is not the only way to do this. There are lots of ways to do this, but any way that you do it should be based on valuation principles, growth opportunities, and risk tolerances and goals and objectives. Thanks for watching.